వైట్ ఎంత వస్తుంది సార్ అదే
కనుక్కోలేదు Kहाँ तो गए लोग। 46 giant bintang. Arahap ka namin karon Raj.
Santosh sir, are you there?
Yeah, hi.
Good evening. Sir, shall we start the session?
Yeah, we can start the session.
Okay. Namaskar and good evening to each one of you connected to this webinar. Respected Mr. Santosh sir, our speaker today, members of AVP, and esteemed participant registered valuers and my colleagues. I, Kajal Gupta, manager at DJVF RVO and coordinator of the CP, extend a warm welcome to you all on behalf of my organization. As you are aware, topic of today's webinar is IVS 210 Valuation of Intangible Assets. The intangible assets covered in IVS 210 are defined as non-physical assets such as franchises, trademarks, patents, copyrights, goodwill, equity, mineral rights, securities, and contracts, as distinguished from physical assets that grant rights and privileges and have value for owners. They are assets not including financial assets that lack physical substance. Intangible assets are critical to valuation of a corporate. The intangibles are critical to valuation of a corporate. The investment being made by corporation intangible is on the increase. And as an investment is intangible grows, assessing the value of those assets as driver of enterprise value becomes ever so essential. Considering the importance of the subject, we have selected this topic for the program. The subject will be discussed in detail by our speaker today, Mr. Santosh sir. Before I hand over mic to him, I will briefly introduce him to you all. Mr. Santosh sir is a chartered accountant and a registered valuer for asset class securities or financial assets. He is advising multiple startups on various issues, including finance, compliances, and fundraising. He is an avid speaker and is a regular at SIRC of ICI, the Institute of Analytics USA, the Institute of Internal Auditors USA, and various RVOs. He has experience of industry both as an executive in it and also an independent professional. So over to you, sir, for the wonderful learning session of 2 hours. It is going to be an interesting learning session. So over to you, sir. Thank you.
Okay. So thank you, Kajal, for that introduction and setting the idea of the session today. So before we dive into the session, let's take a few minutes giving a background, setting the agenda. Okay. So, I hope most of you would have attended some of my previous sessions, so I'm not going to go back into my introducing myself apart from what Kajal has did already. So today's session is going to be on intangible assets. Most probably, we'll be spending the first half an hour of the session in understanding a little bit of what intangible assets are going to be. That would be the initial part of the session. And then I would concentrate on what the standard IVS 210 is saying on intangible assets. That's going to be 1 hour. And the last half an hour is going to be any question answers that we have, we can have it there. Doesn't prohibit you from asking any questions then and there. If you have anything, you can go ahead and ask me. And setting the idea here, there's not going to be any PowerPoint presentation today, primarily because this standard, we are going to look at the standard itself. There's no, I did not see a point in copy pasting the entire standard into a PowerPoint presentation, running it through, reading it through, and doing the same thing again, and it's both waste of my energy as well as your energy. So one thing that we are going to do is whenever there is a requirement, we are going to directly access the standard itself and we are going to take a look at it. Apart from that, it is going to be more of a conversation. I would put up my points. I respect all the valuers here. So you can give counterpoints, or you can, wherever it is required, you can add your points here. So that's the major idea here. And thank you, DJF, for changing my name. It was Pavitra, my wife's name, because I am at my in-laws' place. Today is a Sunday, so I was at my in-laws' place. This was an unplanned session. I was informed the day before yesterday that I had to take over because there was some change in plans. So I had to join in from my in-laws' place. And I did not carry my laptop also, so I directly took over my wife's laptop. So thank you for that. Now, moving on into the session. So we have been valuers, we have qualified the examination, and we have been doing valuations. Predominantly, if I ask you what are the methods, or let's leave alone the methods, what is the approach that we are using? We'll be using the income approach predominantly. How many of you have done cost approach or market-based approach of valuation? Very little, I would presume. Even if somebody has done it, the proportion would be very less. And even in the income approach, we would be more inclined towards the DCF method of valuation. So that's how we have been doing valuations. And for SFA valuers, it would be predominantly equity share valuation. Plant and machinery, land and building, it's very clearly demarcated. It's going to be land and building and plant and machinery. For equity, for the valuation of SFA valuers, it's going to be predominantly equity share. What is this particular share worth it? For the purpose of fair value measurement, for the purpose of fair market value measurement, for the purpose of income tax and the Companies Act. I interchanged it. So for the purpose of Companies Act, it's going to be fair value. For the purpose of income tax, it's going to be fair market value. So these are the major idea. Now, one area of valuation which we came across in our 50R MEP, but there is not much opportunities for us to apply, is the intangible assets. What is intangible asset? What are the different types of intangible assets? We all memorize certain items in our mind for the purpose of writing the examination. But even I, after qualifying the examination, it's been almost 4 to 5 years. Probably one assignment per year, if I have done intangible asset based valuation, it would have been, I think I've done only one or two assignments per year. So totally I would have done maximum of 5 to 6 assignments, 7 assignments. That's all. But equity valuation, that's a different story. We've done a lot of valuations. But Intangible assets, very little number of valuations we would have done. So the idea of intangible assets itself is a little daunting, and then added to it, how do you go ahead and value? It becomes very daunting. But the entire idea of this session is to remove the myth and to give you an understanding of how easy it is. Though there will be some complication here and there, we will try to address it as we go by. Now, first, let's understand what is an intangible asset. As the name suggests, it's going to be pretty straightforward. Something that is not tangible, something that you cannot touch, something which is not physically present. It does not have a three-dimensional, it does not occupy the three-dimensional space in which we as humans are occupying in this world. It does not have that. But what is essential is it does have an economic importance, and it has an economic value attached to it. Now, giving a broader understanding, whether what is the, so this is again, I'm going to take borrow and steal some ideas from one of the valuation gurus, Damodaran here. What is the most valuable company in the world? When you look at it, two companies emerge. One would be Aramco, the other would be Apple. These are all trillion-dollar companies here. Now, when you look at Apple, when you actually go on to calculate all the physical assets that this company is owning, would you be able to reach that trillion-dollar valuation mark? If a company reaches the billion-dollar mark, we call it a unicorn. And then it goes to 10 billion, we call it decacorn. These companies, Apple, Aramco, and all, they reach the trillion-dollar mark. When you just calculate simply calculating all the tangible assets that the particular company is having, when you aggregate it, do you think the value would reach a $1 trillion mark? No. Before 2000, before 1990s, there has been a point in time when all the valuations were driven prominently based on the value of the tangible assets. After 1990, once the .com came into existence, once internet came into existence, one technology started getting involved in our day-to-day life, that has changed. And now technological intangible assets are valued more than the tangible assets. Now, Ola, Uber, all these companies, Swiggy, Zomato, all the companies that you hear from, Ola does not own a single car. Uber does not own a single car. Zomato, Swiggy, they don't own restaurants. All they do is going to be all that they do is going to be only be an enabler or be a platform and leverage technology in delivering a particular service. So this technology that they are holding, the brand that they are holding, is going to be valued separately, and that value will have to bring it out. Now, let me quickly open up the. Are you able to hear a background noise? If you hear a background noise, let me know. If there is a background noise, I might have to look at something to get it sorted. If not, we'll proceed. Any background noise you hear? Okay, I hope not. No noise. Good. Thank you. So this is the standard. The pros of the standard, pretty straightforward. It is an intangible asset is a non-monetary asset. It manifests itself purely based on the economic properties that it has. So you cannot physically touch it, does not have a physical form. Its value is derived only based on the economic benefit. What is economic benefit? By holding this in future, what am I going to get as monetary return? That is going to be the, sir, I think you might have to switch on your, there is a place where you'll have to connect on computer audio, then you will be able to go hear me. So the physical substance is not there. Future economic benefits is going to flow into the company. That is the only thing this intangible asset is going to have. It has, I might have to annotate. Okay. So I might have to look at here. Specific intangible assets are defined and described by characteristics such as ownership, function, market position, and image. these kind of characteristics are what is going to differentiate your intangible asset from the tangible assets. And then there are 5 different categories. Now, when we would have already gone through all these 5 different categories from in all our examinations, we would have gone through the 5 different categories. Why do I have to again go through this? The idea is to understand what method is applicable to what category. The categorization is not just for the understanding of what intangible assets are, but it is also to understand what method is going to be applicable for which type of intangible asset. The number 1 is going to be your market related. Examples would be your trademarks, trade names, trade designs, and internet domains. How many of you have looked at trademarks? Now, if you have 2 mobile phones that are there, one is going to be an Apple branded mobile phone, and one is going to be a normal mobile phone which is unbranded. And I tell you that both mobile phones are going to have the same exact configuration. It is made by the same exact person, probably in China. Now, let us say it has been transferred to India. So from the same factory, I am getting both these 2 mobile phones. One has the Apple logo behind it. The other one does not have the Apple logo. That's all. No other change. Now, which phone do you think would carry more value? A lot of people buy iPhones not for the purpose of the speed or the usage or anything else. Predominantly, it is predominantly for the purpose of the logo behind it, to showcase that they are in a league apart from other people. So that's the reason predominantly people go on to buy an iPhone. So that market value for that particular logo, the trademark for that logo, is the intangible asset, and that is the value. Next, trade names, unique trade designs. Multiple times what happened is the bottles in which the Coke, Fanta, the Pepsis of the world, how they present the bottle would make a lot of difference. Pepsi would have a different type of bottling, and Coke would have a different kind of bottling. That design itself would market its product separately. Then internet domain names. You have Twitter. If by any chance, if you are able to get this one name, twitter.com, you would become automatically a millionaire. If not a billionaire, you're going to become a millionaire, because you don't have anything, you don't have the technology, you don't have anything, but you'll be able to charge $1 million based on only holding that particular domain name. There was this, if my memory serves right, Elon Musk used to own a domain called x.com, which was during before PayPal took over X bank. He was holding this domain name called x.com. That in itself was carrying a huge value that drove the valuation for that company when PayPal took over x.com. So internet domain name also is a kind of marketing related. Anything the customer would be willing to pay for, to identify it separately, and the company would be able to differentiate and market separately, that is marketing related. The next comes your customer related. Customer related are predominantly your customer lists, backlog work, customer contracts, and contractual non-contractual relationships. Now, recently, I went on to value one company where they were having relationship with one company in the Australia. I think I can give it's a big name, so I can easily give it. It's Emerson. There was this company called Emerson. This company in India had a contract with Emerson. Not a contract, actually, they have a contact, they have a relationship with Emerson. Whenever there was the specific particular item that is required, they knew these guys were the best on it. They had the technology to do it, they had the labor force to do it, they knew it. Though there was no contract, written contract, thing was there, but still they had the owner, the founder of this company A in India had a relationship with Emerson. So every time Emerson wanted it, they came back here. So that is customer related. There is it does not have to be anything written, it can be unwritten also. That is a value that adds value to this particular, added value to this particular deal. So when this company A company was taken over by B company, they paid a premium for it, for this particular contact and the relationship that they were making. Customer backlog and all, automatically it is of higher value. Why? Because the moment you say there is a backlog order that is pending, it is as much as a work order that is pending. They were ordering 100 units. I have completed only 10 units. 90 more units. I have a SOW document with me, statement of work. I can complete it, get the money. So pretty much the order is in hand. That is going to be helpful. Next is artistic related. Harry Potter was written by J.K. Rowling, and there was a brief point in time when J.K. Rowling was the richest person in the UK, surpassing the Queen. So the royalty she was getting for Harry Potter took her above the actual royalty in the real world. So that kind of intangible asset that you hold is artistic related. It can be a book, as this example runs through. It can be a play, it can be a movie, it can be music, it can be any kind of art. It can even be a non-contractual copyright protection from non-contractual copyright protection. Now, A.R. Rahman went on to compose this beautiful theme for Airtel. When he composed that theme, whenever that song runs through, the tune runs through any place, the first thing that will come to our mind would be Airtel. For Airtel, it is a marketing related intangible asset. But for A.R. Rahman, it is an artistic related intangible asset. So the same intangible asset, for one person, it will be categorized in a different format. Another person, it will be categorized in a different format. That is something that I would want you to understand. For A.R. Rahman, it would be artistic. For Airtel, it would be marketing related. People would recall. So the annotation would not go away. Fine. Now, finally, the fourth one would be your contract related. If there is an existing contract, if there is a licensing agreement, there is a royalty agreement, or if there is an existing contract, supply agreement, SOW that is there, master service agreement is there, that would carry a value. If you have taken the franchisee for franchise for Starbucks, when Starbucks franchise is not obtainable in India, that's going to give you a lot of value. There is servicing agreement, employment contracts are there. You have the best minds in the world or for particular technology, and you have a non-compete agreement with all these employees, or you have an agreement that they will stay on for so many number of years till they complete this particular product. These contracts where you're able to restrict the movement or restrict competition by employees, that is going to be a contract based intangible asset that will also have value. Natural resources. So if you have won a contract to go on to take out lithium from the Kashmiri mountain regions, which I think now recently they have found out lithium is present in the Kashmiri mountainous Himalayas. So you have a contract from the government to go on and take out the particular lithium, extract it, and you are able to sell it. That will have a value. Now, technology related intangible assets arise from contractual or non-contractual rights. It can be patents, it can be designs, it can be softwares. You have the software, the source code for Microsoft Office, that is going to be valuable to you. If you have the formula, let us take the very simple, much advertised 7 herbs or 12 herbs, some number of herbs that KFC uses in all its food products. That 7 herbs that they are talking about, the recipe in which they are making it, that's going to be very valuable. I don't know how many of you follow this particular TV show, the one before Friends. There was an episode called Soup Nazi, where this guy, he goes on to make soups, world-class soups. People would stay in lines in New York City to get the soup. And then one fine day, his secrets of how to make this soup, the recipe would go out, and he'll go out of business. Because the moment the recipe goes out, everybody would be able to make it. Till the time the recipe was there, nobody was able to make it. So the same way, formulae, database, technology, unpatented software or patented technology, software processes, recipes, all these are technology-based intangible assets. Now, these are the 5 different categories. I know this you would have already covered during your 50-hour MEP session, but then I'm just setting the context here. Next, another 10-15 minutes, more minutes, you're going to hear only broad understanding. Then we'll go into the standard per se. I'm going to remove the annotations here. I would be very happy if you can refrain from annotating. I understand that this would have happened by mistake. Please clear all drawings. So please don't scribble here. It becomes a problem for me to move on. Okay, I'm going to skip the other one. Right. Particularly in valuing intangible assets, valuers must understand specifically what needs to be valued and the purpose of valuation. Now, what needs to be valued is very important. Just because the name has customer in it, the intangible assets name has customer in it, you cannot club everything together. A customer contract and a customer database are 2 different things. You should understand what that particular intangible asset is. Just because I have all the list of all the valuers to me, let us say I am developing a valuation software. I go to IBBA, I will be able to see, I make a request, I will be able to see all the list of valuers that are currently there. Now I can leverage this particular information. I have the phone numbers, I have the email ID. I will send out a mass email to you all. I'll call you up everyone individually. I'll put up 1,000 cold callers. I'll call everybody individually and I'll try to sell the valuation software to you folks. Now, how much value would I be able to get from this would be very different from me entering into contract with 20 already existing valuers who are already using my software. So this is a customer contract. I have entered into a contract and they are already providing me money for the services, for the software that I have already given them. That is different from customer database, which I should leverage and get information. Now, customer contract is different from customer relationship. I know 20 people here. I have a good relationship with them. It's not database, just database. Of the 1,000 people, I have 50 contacts. Of that 50, 20 people are going to might buy my product, particular product. So this is customer relationship. So you should have a clarity of what that intangible asset is before you go on to value. That is number 1. Number 2 would be, what is the purpose for which you're going to do the valuation? That is also important. If you're going to you do it for the purpose of transfer pricing, it's a different method that you might have to use. If you're going to go and do the valuation for the purpose of internal assessment, for tax reporting purposes, or for the purpose of, let us say, financial reporting purposes, it will have completely different use cases. I have a particular asset, intangible asset, which I'm trying to sell. I should look at it from the sell side. Particular intangible asset I'm trying to buy, I should look at it from the buy side. So all this purpose and basis of value needs to come into play when you're doing the valuation. Now, one important thing that you might have to understand is goodwill. Is goodwill a part of intangible asset? 100% it is part of intangible asset. But how do you, or how do you arrive, or how do you, oh, thank you, Seinfeld. Yeah. So that was the name of the show. So how do you go on to define goodwill? In classic terms, every intangible asset are individually definable except for goodwill. Predominantly, goodwill is a residual item in your calculation. It is like alpha, where you go on to calculate the market return, and you go on to calculate your return. Whatever is the difference you are able to make over and above the market return, that is your alpha for the other party. But when you are the receiving party, let us say you are the receiving party, I bought a particular product more than the market value. Then the difference, how do I account for it? I give it a beautiful name, goodwill. Out of goodwill, I bought it. Out of my good nature, I bought it. I paid extra. Something was worth 10 rupees. I paid 12 rupees and I bought it. The 2 rupees extra that I paid is going to be goodwill. Now, there are certain cases where people go on to calculate the goodwill for very limited purposes, which does not fall into any definable intangible asset. Example, an assembled workforce. So if there is a factory, there are tangible assets in the factory. And then there are going to be n number of intangible assets. The brand would be there. There's going to be patent. There's going to be processes. All that is already factored inside. Then we go on to find out that there is a particular value for getting all the skilled labor already assembled and ready to be shipped, ready for the product to be shipped. I have the people ready then and there. I cannot define it separately, so I pay goodwill to that. So this kind of definable, undefined intangible assets would fall into goodwill as this definition. Now, so now there are people who classify goodwill also as transferable and non-transferable. Based on whether it is transferable or non-transferable, sometimes it will be used in the case of US GAAP. You can only recognize goodwill if it is separable, irrespective of whether it is contractual or not. If it is separable, you can recognize it. In the case of contractual or other legal rights, regardless of whether those rights are transferable or separable from the entity or from other rights or obligations, if it is arising from purely contractual, then you can do it. If it is purely if it is properly separable, you can do it. Or it's in either or definition there. Now, while the aspects of goodwill can vary depending on the purpose of the valuation, goodwill frequently include the elements such as this is what I explained before: company specific synergistic benefits. Number one, you will have to let me give you an example. Tata Motors is going to go on to buy an EV factory. Maruti Suzuki is going to go on to buy an EV factory. Which one? Or EV factory, when I'm saying, I'm going to say lithium ion batteries. One particular company is making. Santosh Limited is making lithium ion batteries. Tata Motors is coming and offering me a price. Maruti Suzuki is coming and offering me a price. Which company do you think would be offering me more price? Santosh Limited is making lithium ion batteries. Tata Motors has reached out to Santosh. They are telling me that X amount I would pay. Maruti Suzuki has reached out to Santosh. They are saying Y amount I'll pay. Which one do you think is higher, X amount or Y amount? EV is already there on board. That's why I corrected. I make lithium ion batteries alone. So X is more or Y is more? Who will pay more? Who will pay me more? X would pay me more or Y would pay me more? Tata will pay more because they have an EV on the road. So they'll be ready to pay me more because that's going to work with their existing fleet of cars.
But sir, it can be other way around also, because Maruti may have the more appetite, but they want their EV on the road, so they want to compete with Tata.
Agreed.
So it's nothing but a competition. We cannot judge who will pay more. It is again the market situation and the thrust of both the companies who wants to, get into contract with that particular Santosh Limited. It cannot be X or Y can give you more. It all depends on appetite of both the parties. Who is ready to pay more? That's it.
That is one of the reasons. I agree with your point. That being said, if you consider Maruti to also enter the EV market, I agree they both are in the same grounds. Now X or Y, either of it would be able to give me more. But when it comes to a point where Maruti Suzuki currently it does not have EV in the road, number one. Number two, okay, I spoke without giving you the context. Maruti Suzuki's MD, managing director, came out very recently in one of the interviews where he said we are not interested in making electric vehicles. In this case,
in that case, scenario completely changes.
correct.
In that case, why the Maruti will go for bid at all when they are not interested in EV?
That you should. So that is the entire point. I will give you an idea. I will give you an understanding. Now, what happens is there was this. You would have all heard about the Bhopal tragedy where this carbide company was there.
Yeah.
They had a massive tragedy that happened. Now,
Yes.
what happened was at that point in time, a little later, they were also making these batteries. When the particular company was the company was closed, the management ran away. There was one beautiful thing that happened where a washing powder company went on to purchase this particular company, the battery manufacturing company. Nobody had a clue what this company is doing. They went on, they purchased the battery manufacturing company, sliced and diced each factory separately. They sold off factory by factory, asset by asset. They chopped it off and they sold off almost the entire company. They chopped it off and they sold it off. If my memory serves right, okay, let me take a hypothetical scenario. They bought the company for 100 rupees. They chopped off and sold the entire company for, let us say, 90 rupees. People were wondering, why did this washing powder company go on to buy a battery manufacturing company, chop it up and sell it in pieces? Then came the clarity when people said, when the management of the washing powder company told that this particular company, battery manufacturing company, they were able to have a beautiful distribution network where the batteries reached to every nook and corner. At that point in time, electricity was not there in every village. So this battery has to reach out to the every nook and corner of India so that these people were able to use torch. In the night, they did not have electricity. They were able to use torch. So that company, the carbide company, was able to have a beautiful distribution network which reached every nook and corner of the country. Though the washing powder company removed everything else, they retained this distribution network. They had the names of all the distributors. They converted them to washing powder distributors. Though it was chopped and everything was sold, this particular distribution network was used. The same way in EV also that can happen. A lot of companies have been used like that. Thumbs Up was bought by Coca-Cola. They are still carrying it. They tried to kill that company just to stop it from competing with them. Even now they are trying, but Thumbs Up is not dying. So brands, companies, they will have all kinds of motives. We will not be able to give a single motivation. We will not be able to.
Absolutely. Yeah.
Yeah. So that's the idea. So coming back here, a Tata Motors, a company which has more synergistic benefit, would be able to give me a better value. So how company specific synergies arise should be taken into consideration. Opportunities to expand the business into new and different markets, that needs to be considered. If I'm buying a company in Sri Lanka, I would be able to leverage and enter into a new market in Sri Lanka. So that can give me benefits. That needs to be considered. Benefits of assembled workforce, that needs to be considered. Benefit derived from future assets such as new customers and future technologies, that needs to be considered. And assemblage and going concern value, that needs to be considered. So all these 5 factors needs to be considered when we are doing a valuation. I'm just going to quickly run through because we overshot here. Okay, I'm going to skip this one. What are the purposes for which intangible assets valuation are going to happen? Number 1, it's going to be for the purpose of financial reporting purposes, impairment analysis, goodwill needs to be calculated, intangible assets value needs to be calculated, so that the market value and the value in use, if they calculate, they'll have to find out whether there is any impairment in that particular assets value, needs to be accounted. For that, they'll do a valuation. Tax reporting purposes, for the purpose of income tax, valuation can be done. Intangible assets. So sometimes what happens is even transfer pricing, the same particular intangible asset which is owned in India will be used for the purpose of making sales in India, in the US, in the UK. So what percentage of expenses should be booked in India? what percentage should go to the UK, what percentage of expense should go to the US. For calculating that, we might have to calculate the value of the intangible asset first. In some lot of cases, litigations come through. In the case of litigation, if there is a litigation that is going on, the courts would order for a valuation to be done of that intangible asset. For the purpose of statutory and other legal reasons, you might have to go on to do the valuation. And valuers are often asked to do intangible assets as part of consulting, general consulting work. If there is a sale, if there is going to be a purchase or any transactional support that is required for the management to take some decisions, we are asked to do a valuation. So broadly, these are the categories of doing the valuation. Basis of value, simple. What basis of value that you're going to use? Are you going to use a liquidation valuation? Are you going to use fair value? That needs to be determined. Go back to 104. Understand and come back. That is the idea that IVS 210 is giving. Now, when it comes to a simple example, there is this company called Kingfisher. The Kingfisher Airlines, it had extraordinarily huge value. It had also a beverage brand named Kingfisher. Now, for a point in time, millions of dollars, maybe $1 billion was given as loan to this company simply based on collateralization of this brand. Just the brand was given as collateral. Obviously, there were other tangible assets also were given to an extent, but a lot of value was assigned to this brand for giving this particular loan. Now, at some point in time after the Vijay Mallya fiasco, the moment people were able to understand there is a problem with this company, the value of the brand dropped to negligible values, negligible amount. Why? Because intangible asset is standing on its both the legs, and both the legs are economic benefit. The moment you find out that this company will not be able to save itself irrespective of, in spite of, not irrespective, in spite of holding that particular intangible asset, the intangible asset does not have any value. That needs to be considered. So when you are doing a valuation, that's the reason whenever the banks are doing valuation, they do both in liquidation valuation as well as forced sale. What would be the value? In normal market conditions, what would be the value? Even in the case of IBBA valuation, insolvency valuation, both valuations are being done. Now, valuation approaches and methods 105, you might have to go back to 105. I'm not going to go to 105. I'm going to give you a quick recap of what happened in 105. In one of the previous sessions, we have discussed this. Whenever you do any valuation, the first method that you might have to go on to do the valuation should be the market method. This is not me telling you this. It is the standard. The mandate is for you to use the market method. Anybody who wants to tell me why market method is the first method that you should use to do the valuation? Why does the valuation standard prescribe market method? It says do only based on market method. If only market method is not applicable, then you go on to other methods. Why do you think the valuation standard has to come out and prescribe you, tell you that use only market method?
So because that is the method in which the willingness to pay by the larger people comes out.
Okay. Right. You have summed it up well. Okay. Anybody else who wants to take a shot? The concept that 105 defines when saying that why to use market method as a first method is that it defines something called market observable information. Normally, there is this market. So there is this famous experiment that was done where people were asked to come and sit in a row and they were asked to predict what would be today's closing rate of Nifty. There were 100 people who were sitting down. 100 different notes were taken. 100 different points were taken from all these 100 people predictions. And then they were able to find out that the average of all these 100 was the most nearer, it was most near to the actual closing of that particular index. So usually what happens is market will define or market would dictate the value, because at the end of the day, you throw whatever amount of water into the sea is going to remain the same. That is the market. The same way, market is going to define, control, and change the direction of any value of any asset. Therefore, the more the information that you take from the market is going to give you more accurate picture of your valuation of that particular asset. Which is the method or which is the approach which utilizes the maximum information from the market approach. Does it mean that income approach does not use it? It does use it, but to a limited extent. But the maximum utilization of market observable information is the market approach. That is the reason why market approach is the preferred approach. Now, that is where we start. Whether market observable information is available, market observable comparatives are available, you'll have to check. Only if that is not available, then in the income approach, you might have to see whether you would be able to make predictions of the amount and timing of the cash inflows and outflows for that particular company. If that is, you are able to do it, you go on with the income approach. And only if that is also not possible, then you go on to the cost approach. So the approach prescribed by the valuation standard is clear. First market approach, that is not possible, go to the income approach. If that is not possible, go to the cost approach. The hierarchy is clear. Now, the difference between approach and methodology also, let me repeat it. The approach is like the direction. Now, if you want to go towards north, that's the approach. I am from the south. I am from Chennai. I want to go to Delhi. And I am going to take the route which first takes me from Chennai to Hyderabad to say some place, say probably Mumbai, and from Mumbai I'm going to Delhi. That is the route that I'm taking. That is going to be the method. So the broad direction would be your approach. The exact route that I'm going to take is the method. So this is the idea. So 3 approaches. Under each approach, you can have multiple methods. Now let's dive on into the market approach. Market approach, it's pretty straightforward. Market approach, there is one important thing that you'll have to see. I'm going to skip all the other pros here. Apart from what is defined under 105 approaches and methods, 210 defines 2 more conditions. Only if these 2 more conditions, apart from what is defined under 105 is satisfied, you will be able to use market approach for the purpose of intangible assets. I'm repeating it. In 105 approaches and methodology itself, they are giving you a set of conditions, predominantly 2 conditions. If the asset satisfies those 2 conditions, you will be able to use market approach usually. When it comes to intangible assets, apart from that, it should also satisfy 2 other conditions. What are the 2 other conditions? Information is available on arm's length transactions involving identical or similar intangible assets on or near the valuation date. You should take the valuation date, and on or near the valuation date, there should be some similar or identical asset which was transacted, and it should be on arm's length basis. So there should be a buyer, there should be a seller. The buyer should not know the seller, or the seller should not know the buyer. So they are separate parties, not related parties. There should be a transaction that would have happened, and the transaction should be for intangible assets, and that should have also happened on the or the near the valuation date. This is first condition. Second condition is an unrelated condition. So second information is also should be satisfied. Then only you can use this method. Sufficient information is available to allow the valuer to adjust for all significant differences between the subject intangible asset and those involved in the transactions. Now, this is the beauty. First, buyer is there, seller is there. They should not be related. There should be a transaction between those 2 parties, and it should be an intangible asset. That intangible asset should be identical or similar. It should have happened near the valuation date. If all that condition is satisfied, second condition is more important. You as a valuer should have access to that information first. because if it is a public information, you would have access. Otherwise, you would not have access. So you as a value should have access not only to what happened in the transaction, but also have access to finding out adjusting factors. That particular intangible asset and what you have might be similar, but it will not be the same. If you have the same, why do you need to do the valuation at all? So it will be similar but not the same. Therefore, there needs to be some small adjustment that needs to be made, and that adjustment you should be able to make. McDonald's is there, KFC is there. Both are similar kind of brands. If McDonald's, you have a very clear brand transfer that has happened and you know what is the value, can I directly take that and use it in KFC? No. Why? That asset is not identical, it is similar. That and this you might have to compare, and you might have to find out what is the difference. KFC, the main product that they are selling is fried chicken. In McDonald's, it's the burger. There will be small differences that will be there. Probably McDonald's, they will go with Coca-Cola. They will have an engagement where there is a co-joined McDonald's and I'm just shooting on the stars here. I don't know whether there is a contract that exists or not. McDonald's and Coke, they would have a joint agreement. Based on that, they would have approached the market. KFC, there might not be any agreement at all. So all these small factors you might have to have. You should have the visibility, and you should have the information to adjust for these factors. Only if that is there, you can go with the market approach here. Now, in a lot of cases, the heterogeneous nature of the intangible asset and the fact that intangible assets seldom transact separately, it means that you cannot use the market approach, and it will not also have identical assets. Sometimes it will have similar assets, identical assets transfer will not be there. Most of the times, slump sale would have happened. The business as a whole would have been sold. Sale of a single intangible asset is very rare to come by. That's that paragraph, where evidence of either market prices or valuation multiples available. Valuers should make adjustments to these to reflect differences between the subject asset and those involved in the transaction. What has happened, don't take it directly. Use your adjustments. Now, when I say adjustments, it will not be quantitative adjustments, it will be qualitative adjustments. There will be a lot of valuous discretion that will be involved when you go on to do these adjustments. As a valuer, I would say that this and that are same. While when you are looking at from that side, you might say, no, sir, how do you say this and that is the same? It's not the same. They are a lot different. So these are all qualitative adjustments that you'll have to do. Now, there are certain cases where market approach would be very easily. You can go ahead and use it. Number one would be your broadcast spectrum. No one would have forgotten the 2G, 3G, 4G. Because of the scam, you wouldn't have forgotten about 2G, 3G, 4G broadcast spectrum rated auctions that were held. In those cases, pretty straightforward. The government has auctioned it out, only the spectrum, which is an intangible asset. Therefore, public information is available. Public information of public market information is available. You can use it to do the valuation. Straightforward. Internet domain names, you go to whois.com, you go to godaddy.com, you'll be able to find out what is the value of that particular similar kind of domain names, at what price they have transacted. You would be able to see that. You can take it. Taxi medallions, this is an interesting case. Now, taxi medallion, though it has physical form, it is more of a right bestowed on you, which is the intangible asset. So I'll give you, for people who are not initiated, I'll give you an understanding. In New York City, this was before the Olas and Ubers, taxi for sure and all. You can fly a taxi in New York City only if you have a taxi driver's medallion. There was this Jackie Chan movie also called Medallion, where it will be a round object which you will wear it in your shirt, and only if you have that medallion you will be allowed to fly. Just like your auto walas now, they belong to a particular stand, only they will be allowed to take people from there. So that taxi medallions used to be sold for hundreds of thousands of dollars, not tens of thousands, for hundreds of thousands of dollars at that point, way back in 70s and 80s. In today's value, it would be hundreds of thousands of dollars, because the moment you have a medallion, all the yellow cars that go by, you will be allowed to fly within the New York City and make money. If you want to fly, you might have to go on. There is no, that it is restricted. You cannot take it from the government. There are only X number of medallions that is issued. If you want to fly, you'll have to find out one person who is ready to sell it to you. And this kind of sales was very frequent. It would be registered with the government. Therefore, you will be able to get that information. So taxi medallions, directly market information is available. There you can go ahead and use the market method, market approach. Now, the guideline transaction method and the public
Sir, one day we can hope that our auto walas will also get valuation for their stand presence or so.
Actually, that is anyway that is happening. So in case if you want to ply an auto, actually you'll have to go and pay some amount as a auto stand fees. It is already happening. One person has to move out and you will be accommodated there and you'll have to pay a fee. It is already there. That is an intangible asset. Only thing is they don't call it as intangible asset. They just call it as a group fee and they collect it.
Great.
Yeah. So now moving on to the guideline transaction method, that is the generally used market approach that can be applied to the intangible assets. In rare circumstances where the asset is subject asset is publicly traded, guideline public company method is being used. So nothing much here. So contingent value rights. So contingent value rights are in shares. What happens is if a particular company reaches a particular level of profitability, so much amount of option. It's an option pricing model, where in case if a company reaches an X amount of revenue or X amount of profit, you would be paid X amount of money. So that option would be traded in the market, and if you are holding it, you can use guideline public company method. Otherwise, you go on to use the guideline transactions method. Moving on to income approach, the second approach and the only approach that is going to matter. In fact, cost approach, market approach, apart from these very little cases, you will not be using income approach. We are going to use it. So income approach, I'm going to skip the pros here. Directly, I'm going here. Where can it be frequently used? In the case of technology, in the case of customer related intangibles, in the case of trade names, trademarks, brands, operating licenses, franchisee agreements, gaming license, broadcast spectrums, and non-competition agreements. In all these cases, now I hope you would have an understanding of why we were categorizing these intangible assets as 5 different buckets initially, for the purpose of where it can be used. Now, when you come to income approach, 5 methods are there. Approach is the direction, methods are the route that you're going to take. Sir, I'll tell you what. In any case, the objective is very simple. Valuation of intangible asset. Number 2, valuation of intangible asset is tough. You will be able to value only the company as a whole, all the economic benefits that is going to come. In all the 5 methods, in one method, I'm going to use a broomstick to switch on the light. In another case, I'm going to use a walking stick to switch on the light. In another case, probably I'm using a calendar to switch on the light. All the methods are like the object that I'm holding. The objective is to switch on the light. So that is the idea. Now, when you look at it, when I go through, you will be able to understand, sir, pretty much all 5 are something similar. But you will understand why there is small differences as we go through one by one. Now, in the case of excess earnings method is predominantly a concept where we go on to calculate the revenues that we will be getting from that particular, by using that particular asset, and all the expenses we remove it off. And after removing the expenses, we go on to calculate what are all the other contributory assets that helped, apart from the intangible asset, to get that particular revenue. I'll give you an example. Now, Apple is selling mobile phones. When Apple is selling mobile phones, obviously they are able to get the manufacturing done. They have the technology. There are a lot of physical assets that are present, and there is also the brand that is there. Now, when I want to do a valuation, what happens is I'll have to do the valuation, let us say, for the intangible assets. I want to do the valuation of the technology. I want to do the valuation of the Apple logo or the brand that is there. Now, when I want to do two valuations of two intangible assets, which is resulting in one single revenue, what should I do? There is a problem. I cannot remove one because then I go into a circle loop. Only if I know the value of one particular intangible asset, I will be able to value the other intangible asset. To resolve this problem, what what the standard says is you can do the primary intangible assets valuation through the your excess earnings method. It can be 3 different methods inside excess earnings methods is there. I come there, but you do it through the excess earnings method. And the other intangible assets, you have other methods that are available later. You can use that and do the valuation. So this is the idea. Now, in this context, you might have to look at the contributory assets. What is contributory assets is defined here. These are the assets that are used in conjunction with the subject intangible asset for realization of the profit. You have understood that. Now, there are 3 sub methods that are there. One is the multi-period excess earnings method, single period excess earnings method, and the capitalized excess earnings method. Predominantly, the most important and the most used method would be your multi-period excess earnings method. What do we do here? I'm going to give you the outline, the method here. You don't have to take any notes. Directly copy paste this in all your valuation reports if you are doing an intangible asset valuation, and step by step you can follow. First, go on to forecast the amount and timing of all the cash flows that is going to come in. Okay, that is number 1. Related to the contributory assets, intangible asset and the contributory assets. Next, we go on to calculate all the expenses related to the intangible assets and the contributory assets. So first, all the iPhone sales that is happening, I'm going to take that. All the expenses related to the iPhone sales, I'm going to take that. That minus this. Then I adjust the expenses so that it does not include anything related to creation of a new technology, new intangible assets, or with relation to any extra customers that is being created. 2 things can happen. Apple is running a company where, let us leave out all the other business lines. It is only manufacturing iPhones. I am taking the total sales of iPhones that has happened, revenue. I'm reducing all the expenses in relation to the manufacture of iPhone. So that is essentially your P&L of that particular company. In that, I find out there are certain expenses in relation to creating a new product called iPad, or be whatever it is, the new product that is there. I might have to remove it. I might also have to remove, there are 1,000 people, 1,000 customers previously I have served. I am trying to increase it to 2,000 or 3,000, creating by engaging in marketing activities. That I should not consider. That expenses I will have to add back. Expenses related to new research and development for new intangible asset, that needs to be added back. Any marketing related expenditure for additional customers to be served, I'll have to add it back. Whatever is the remaining value, that value I'll have to take. Now, identify the contributory assets that are needed to achieve the forecasted revenue. Now, what is contributory asset? As I told you, apart from intangible asset, all the other assets, which can be tangible or intangible, which worked along with this intangible asset to give the value for making that sales to happen. That contributory assets, first I'll have to identify. Okay, I needed this particular truck to deliver the mobile phones. I needed this particular factory to manufacture the mobile phones. All this I might have to identify first. This might include even your working capital, the amount of money that you have set apart, so that there is a working capital that is being that is happening, that you might have to identify. Now, once you identified all the assets that are there, you take the asset and you go on to find out what is the appropriate rate of return for this particular, for each and every contributory asset. For the truck, what would be the rate of return that is expected in the market? For the working capital, what would be the rate of return? Very simple. In the case of working capital, what is the OD rate for additional funds that of my utilization in marginal incremental working capital requirement? If I'm asking what would be the rate the bank will be giving me, that would be the rate that I should apply. In the case of truck, what is the value? What is the return that is expected from a truck? That is very easily ascertainable. A truck in the market would earn me, if I apply it on hire, I will be able to, 1,000 rupees truck would be able to earn me 100 rupees every year. That I will be able to easily identify. The same way I'll identify all the contributory, for all the contributory assets, I'll identify the appropriate rate of return. Now I multiply this rate of return with the value of the contributory asset. Contributory asset value I know, rate of return I know, I will multiply. Whatever is the return that I am expecting, that I will reduce it from the value that I identified here. A minus B plus or minus C adjustment, whatever value I've done, that subtotal, I will reduce this rate of return that I've expected from the contributory asset, I will reduce that. Whatever is the remaining value that I have is the excess earnings that I have by having only this intangible asset. Go on to calculate the discount rate for that intangible asset and do a capitalization to find out a value. That would be the value of the intangible asset. I know that this is the first time you would have heard about this in detail, and there is a high chance I am not coming out very clearly also. If you have a question, stop me here. If you want a repeat, I will repeat. Anybody who wants to have a repeat of what is said, or I can give a summary. If everybody has understood, fine. Let's move on.
So please give a summary.
Repeat. Okay. Sir, first we will calculate iPhone companies. Apple is there. Apple is manufacturing only iPhone. They are not manufacturing anything else. No iPads, no MacBooks, nothing. For that company, I will calculate what is the total revenue coming from iPhones. Then I will calculate all the expenses, the material cost, all the expenses that is related to the manufacturing of iPhones and selling of iPhones. I will reduce it. I will have the gross profit. From this gross profit, I will make certain adjustments from the, so this gross profit is there in their P&L also. In that expenses that I told you, there will be certain expenses that will be related to creation of new product lines. There's certain expenses which is in relation to reaching out to new geographies, new customers. All that I should not reduce. So I should add that back. So purely selling one iPhone to my existing customer, what is the value that what is the revenue that I'm able to make? What is the profit that I'm able to make? Revenue minus expenses, profit, that I will calculate. This will be the first part of it. Next, in making this particular, from this profit, I might have to reduce one thing. In making this happen, I would be using two assets. One is my intangible asset, which is the subject asset I'm trying to value. And then there are all the other assets that is involved in making this particular, which will work along with this intangible asset to do the, to make that sales to happen. Just because I have the brand, I cannot sell. I should manufacture. I should be having a plan to manufacture. I should have a truck to deliver it. All these other contributory assets that are there, I should identify all the contributory assets. And for all the contributory assets identified, I should find out what is the rate of return that is expected in the market. So in the case of working capital, there is 7%, 8% return that is expected. In the case of a truck, say 9% is expected. In the case of the factory, let us say 12% is expected. Now I will take all this assets value and multiply it with the rate of return. So if the truck is worth 100 rupees, the working capital that I'm using is 100 rupees, and the plant is worth 100 rupees. Plant 100 rupees into 12 rupees is the expenses that I have to, I mean, the return that I'm expected for the contributory asset, I will keep it separately, 12 rupees. 9 rupees, which is 100 rupees of the truck into 9%, 9 rupees, I'll keep it separately. Working capital 100 into 7%, 7 rupees, I'll keep it separately. This 12 rupees plus 9 rupees plus 7 rupees, that comes to about 28 rupees. I will reduce it from here. Whatever I have calculated here, the subtotal here, I will reduce it from that. The remaining value that is arrived, let us say 100 rupees minus 28 rupees, 72 rupees. That 72 rupees, like this, I will do it for multiple years. 5 years I'm doing it. And whatever is the discounted value of this 5 years is going to be, that value would be the value of the intangible asset.
So, but this is very similar to discounted cash flow or the residual method that we do.
Absolutely right. Only difference is, first method you do it in DCF. Second item also you do it in DCF, where you do this in DCF, you do this in DCF. This one, adding back of expenses and reducing of contributory assets will not happen in usual DCF. In the case of excess earnings method only, we'll do it. It is DCF only. Income approach is DCF.
Okay. Thank you.
So we predominantly use DCF. We are using DCF. What we are doing is, anything not related to the intangible assets, we are adding back that. The expenses we are adding back. Anything not related to the intangible assets, which is already charged, we are reducing. That is the contributory asset charge. We are reducing that. So what we are able to earn only from this intangible assets, we are able to figure out in this manner. So that is the idea here. So the contributory asset charge should be made for all the current and future tangible or intangible financial assets. So let me try to do one thing. Okay, so I have bad access to keyboard here. Let me not do that. I will give you an idea here. So in the case of contributory assets, not only assets that are existing as on date, but assets that would be required in the future also needs to be taken into consideration. If I am going to use this particular asset would be worn out, and I am going to use an additional asset, or there will be a small change in technology, so I might have to replace the existing asset, all that I might have to take it into consideration. The determination of CAC of elements of goodwill is appropriate, if appropriate, should be based on an assessment of the relevant facts and circumstances. Usually goodwill should not form part of your contributory asset charge. Usually, in very rare cases, assembled workforce related goodwill alone, we can take that into consideration. Otherwise, we should not take that into consideration. So goodwill usually will not form part of CAC. When it is related to assembled workforce, in certain cases, we take that into consideration. Now, CACs are generally computed on an after-tax basis. You will have to take that on after-tax basis. We are overshooting time here, so I'm going to skip a couple of very basic points here. Next, should be applied only to a single intangible asset for any given stream. So whenever you are doing multi-period excess earnings method, you can do it only for one intangible asset. iPhone is sold based on the technology, the patents that it holds. Number two, based on the brand it holds. When I am doing multi-period excess earnings method, I can do it for only one intangible asset. Therefore, I will use it only for the brand, let us say. And the technology needs to be ascertained using some other method. It can be used for multiple different categories though. So the brand, how can it be used for MacBook? How is it being used for iPhones? How is it being used for iPads? Separately, that can be used, but it cannot be used for a single product. Two different intangible assets being created, being valued for a single product, it is not allowed using multi-period excess earnings method. So whichever is the predominant intangible asset that you value using multi-period excess earnings method, the other intangible assets, you go on to use other methods that are there available. You go on to use that. Sir, very simple, sir. In all the intangible asset valuation, in income approach, what is the income I'm earning? I'll find out. I'll do a DCF only. I'll do a discounting. I'll arrive at a value. In this method, excess earnings method, I identify something as contributory asset, and for that, what is the return in the market they are asking, I will reduce that, and I will arrive at the value. That's all. In the case of relief from royalty method, there is a small change. In the case of relief from royalty method, which is one of the methods that I used to do a valuation for one of the companies which I have valued. So I'll give you a live example which I handle. There was this company which was manufacturing a particular starch for the purpose of hydrocarbon extraction. So this company is, so usually what happens is for drilling for oil, there will be a big drilling bit that will be used, which will drill the ground, and it will reach depths of in the magnitude of meters or kilometers into the soil to reach an oil pocket, and they will extract the oil. When they drill for oil, what happens is the drill bit that is there, when it drills for oil, it gets very hot, so hot that sometimes the drill bit itself melts and it pours away. To stop that from happening, you cannot pour water and all. You'll have to use certain items, certain material to keep it cool or to dissipate the heat. For that, they use something called starch. The company that I value, they used to manufacture the starch. The manufacturing process is a very long process. It has to, the particular founder, he had a very good understanding of chemistry. He did a lot of experimentation. He came out with this and he started manufacturing the starch. They had 3-4 plants across India. Now, what we did is, we went on, when we started the valuation, we did our study. We went out and reached out to certain experts, the hydrocarbon extraction experts, as well as chemical engineering experts. We found out that this is not a unique product. There were other products that were there, which were, so this company, it was holding a patent for extraction. So what we found out was there were other companies also which had patents for different way of creating of the starch, but the product is the same. It can be used in drilling in the when they are drilling for oil. So what we were able to do is, we were able to find out that these other companies were able to sell it out as a royalty to certain manufacturers, so that it can be manufactured as a white label, and it can be they can use this brand and they can sell it. The process itself was outsourced. The process was given on a royalty basis. Now, we were able to get what the other company was able to charge for giving as royalty for giving this process, patented process out. We were able to get that information. 2-3 companies information we were able to get, because it was publicly available. US company, for the purpose of listing, they had to go for antitrust laws. In compliance with that, they were providing this information to the US government. They were able to get that information, and based on that, we were able to find out what is the value of this particular intangible asset. It is relief from royalty method. If you do not have the particular intangible asset with you, if you are taking it from somebody else, how much of royalty you'll have to pay for acquiring, how much expenses you'll have to make for every year for acquiring that particular asset, that if you are able to find out, you will go on and discount that value, you will arrive at the value of the intangible asset. That is relief from royalty method. You go on to develop, in this method, you go on to develop the projections of the revenue or per unit. So for calculating this, what is the revenue that I will be able to get, or I'm getting in for that particular product, I will be calculating, or the number of units I'm producing, I will be able to calculate. So this would be the first step for the next 5 years, or till the time. So usually this is time bound. Patents are for 10 years, 15 years, 20 years, 16 years. They give it for a time bound period. How many years that is remaining, I will be able to calculate. How much number of units I can sell in that number of period, or how much revenue I will be able to make, I will calculate. Why the units and the revenue? Because usually it will be, royalty will be a percentage of the revenue, or it will be a value on the unit. If you have seen Shark Tank, they would say 10 rupees per unit I should get it. So that is the royalty, or 10% of the revenue I will get. So that would be the royalty that will be there. So you first calculate the revenue or the per unit based on how the royalty is calculated usually. Then develop a royalty rate for the intangible asset. Go on into the market, find out regularly what is the rate at which an arm's length transaction would happen between a buyer and a seller for licensing this particular asset. Royalty rate you calculate. Apply the selected royalty rate on the revenue or the per unit. If it is per unit rate, you calculated the number of units you're going to sell, you calculate that. Or if it is going to be revenue, apply the percentage, you will arrive at a value. Now, estimate any additional expenses for which the licensee of the subject asset would be responsible. Now, sometimes what happens is, licensor will be responsible on certain expenses. If that expenses is already factored inside, it is called gross. If that expenses lies with the licensee, then it is called net. So gross or net, you might have to figure out. Based on if it is gross, you should exclude. If it is net, you should include. Based on your scenario, you might have to figure out, add or remove. This adjustment needs to be made, and that value adjustment needs to be made when you are doing the valuation. If a hypothetical costs and royalty payments would be tax deductible, then automatically you might have to calculate it on tax basis. So after tax basis. When it comes to transfer pricing, the entire context itself is to find out where it needs to be taxed. Therefore, in transfer pricing cases, tax related matters, it is before tax. For everywhere else, for financial reporting purposes, for everywhere else, it should be on an after tax basis. Now, once you calculate that, the value that you have calculated, determine the appropriate discount rate for these for the particular intangible asset. As usual, you'll have to discount it back to the current year. Whatever value you arrive is the value of that particular intangible asset. Essentially, first year I am making 100 crores, second year 200 crores, third year 300 crores, fourth year 400 crores, fifth year 500 crores. I have a pattern the remaining period of 5 years. This is my revenue. In the market, if I have to get a similar intangible asset, I'm using the intangible asset. If I don't have the intangible asset, if I go into the market, I would get it at a 10% discount. I mean 10% royalty on my revenue. What I will do is 100 crore into 10%, 10 rupees. 200 crores into 10%, 20 rupees. 300 crores into 30 rupees. Same way 500 into 50. So 500 crores into 10%, 50 rupees. I am able to calculate. This would be the royalty I would have paid for this intangible asset if I don't own it. What I will do is I will calculate what is the discount rate. This 10 rupees, 20 rupees, 30 rupees, 40 rupees, 50 rupees on different years. I will discount it back, and whatever value I arrive is the relief from royalty method valuation of that intangible asset. Straightforward. Now, whether a royalty is based on whether a royalty is based on, where is this? I move, okay, this. Whether a royalty rate is based on the market transactions or a profit split method, its selection should consider the characteristics of the subject intangible asset and the environment. Now, it can be two ways. If market information is available, then it is based on the market transaction. If market split is not, market information is not available, then you go on to say, they call it profit split method, where we, with our own imagination as a valuer, we go on to find out what would be an hypothetical buyer and seller, how would they split this profit, usually a thumb rule basis. Actually, in the case of marketing, usually there is a thumb rule. Your marketing expenses would be about 30%. Therefore, whenever there is a deal where somebody brings in a particular customer and somebody does the services, it is 70-30. I hope everybody would have heard about it. 70% for the person who executes the work, 30% for the person who has brought in that customer. So this market, this kind of thumb rule based profit split is the profit split method. And if information is available of the market information is available, then you go with the market transactions method. It is dependent on competitive environment, importance of the subject intangible to the owner, subject intangible asset to the owner, and the life cycle of the subject intangible asset. So these three factors come into play when you go with either of the methods. Okay. Now this, I'm going to skip it in the paucity of time. We are going to go with and without method. Again, same scenario. After I explain all the 5 cases, you're going to ask me, sir, there is a confusion. I understand all the 5 cases, but I think all the 5 cases are similar. Yes, it is similar. That is the reason you'll feel as if it is confusing, but it is almost similar. Only the methodology is going to change a little bit. In the case of with and without method, what we do is, there are 2 methods. Comparison of 2 scenarios are there. Calculating the value of the business under each scenario with the different business values being value of the subject intangible asset, and calculating for each future period the difference between the profits in 2 scenarios. The present value of these amounts is used to reach the value of the subject intangible asset. Inside with and without method itself, there are 2 different ways in which you can do. There will be a calculation of profits with the intangible asset. there will be a calculation of profits without the intangible assets. Now, what we can do is we can calculate the profits. The differences can be arrived, and based on the difference, if you do a discounting, that is one method. Or instead, keep the with method separately, arrive at a value. Keep the without methods, without the intangible asset based calculation separately and arrive at a value. The value A minus B, you arrive at a value, that is another method. There is iPhone. Let's go back to our iPhone example. The brand being used, if I use the brand and if I am able to get 100 crores profit the first year, 200 crores profit in the second year, like that for the next 5 years, I calculate that 100, 200, 300, 400, 500. Without the brand, I will be able to get only 10, 20, 30, 40, 50. All this is going to remain the same. If I do a calculation where using 100 to 500, I discount it and I arrive at a value of 1000. And I use 10 to 50, I discount it, I arrive at a value of 100. This 1000 minus 100, 900 would be the value of intangible asset. That is one way of doing it. The other way is 100, 200, 300, 400, 500 is going to remain the same. 10, 20, 30, 40, 50 is going to remain the same. 100 minus 10, 90 rupees. The difference of profit I calculated. 200 minus 20, 180 I calculate. 300 minus 30, 270 I calculate. Like that, the difference I will calculate, and then I will discount the differences, which is going to be how much? 90, 180, 270, 360, 480, 450. I'm going to discount this and I arrive at a value. Again, that will be 900. That is another. So both methods is the same. You negate it and you arrive at the value, or you arrive at the value and you negate it. Both is going to get you the same results irrespective of that. Now, standard, there is a small mistake that is there. This with should be actually without. You should read it as without. The standard, small correction, probably a clerical error that has happened in the standard. So first, what we'll have to do is prepare the projection of the revenue, expenditures and capital expenditures, working capital needs, all that you calculate for the with, which is including the intangible asset, what you will be able to make, arrive at the profits. Okay, and then you find out the discount rate and you keep it separately. And or you can arrive at the value also. If in one scenario we can calculate the value. So do a DCF with the intangible asset inside the company. Next, do a projection without the intangible asset inside the company and arrive at a discount rate, and you discount it, arrive at the DCF value without the intangible asset within the company. So this will become actually without. It is saying with, but it is actually without. Without the intangible asset, whatever value is that, you arrive at that. Now, the value you have arrived as with the intangible assets and the value you have arrived as without the intangible assets, you negate or you subtract without from the with. Whatever difference that you arrive, that would be your intangible assets value. Straightforward, look similar like anything else. I'm skipping this something called a tab for the subject intangible asset. I will come back in the last. I will explain you that. Everywhere I'm skipping that, I will explain you in the last. Now, there are certain scenarios where you might have to also make some adjustments in this particular case, where, see, this particular type of method will be used in the case of non-compete agreements. What happens is, without the non-compete agreement, how much would I be able to make? With the non-compete agreement, how much will I be able to make? I am calculating the value of the non-compete agreement. Sometimes what happens is, there is a possibility automatically itself the other party would not want to compete with you. That probability of the other party not wanting to compete with you, you might have to factor inside. Now, this difference in value should not arise out of change in discount rates only. It should be arrived out of the change in projections. You cannot use this particular scenario where with the intangible asset also I'm getting the same projection. I am giving the same projections. Without the intangible assets also, I cannot give the same projections. The projection should diverge. Not the value should not be different only because of the change in discount rates. Discount rates may change, but the projection should primarily change. So that is the idea. Now comes your fourth method, the greenfield approach. The greenfield approach, it can be used for determining using cash flow projections that assume that the only asset of the business is this particular intangible asset. All other tangible and intangible asset is assumed to be not there in the company, and it is being taken from outside. Now, in the greenfield approach, let us assume this will be applicable predominantly when it comes to franchisee agreements. You can consider it as franchisee agreements. Let us say I'm owning this particular brand called KFC. If I own this brand called KFC, people know about KFC. But that being said, I don't have suddenly, by the snap of my finger, suddenly all my physical stores have disappeared. I have the brand with me, but I don't have any physical restaurant to actually sell the products. Now, how do I go on to do the valuation? Is how greenfield method of valuation happens. Sir, can I go to royalty method? I'll actually franchise it. No. In this case, you might have to look at it as if you are going to create a store for you. So you might have to go on to make all the expenses afresh. The store, you'll have to create it afresh. Any expenses that you are going to make, it is going to be afresh. All the revenue that is going to come is also going to be afresh. Then whatever is the discounted value that you arrive is going to be the value of that intangible asset. It is predominantly applicable only in the case of franchisee agreements and broadcast spectrum. Prepare the projection of revenue, expenses, capital expenditures, and working capital needs for the business, assuming the subject intangible asset, the only asset that is there in your particular company. Any capital asset, including the car that you'll have to use to go to your store, you might have to you'll have to consider as if you are purchasing it now afresh and you're going to depreciate it now. So like that, if you consider, you'll have to consider and you will have to do the projection. Then estimate the timing and amount of expenditures related to the acquisition, creation and rental of all other assets needed to operate the subject business. You might have to create entire HR department. You'll have to create entire legal department. Like that, you'll have to assume and you'll have to reduce the expenses. After doing all these things, usually if you are making, let us say 50 rupees profit, because you are creating it afresh, you'll be making only 10 rupees profit. Like that, you'll have to calculate. Then you will go on to discount the revenues or profits that you have arrived to arrive at a value. That is your greenfield approach of valuation. Here also tab needs to be considered. What is tab? Last. Now, distributor method. Since we are going a little, I'm behind the clock a little bit, so I'm going to give you a direct understanding of distributor method. Distributor method is very simple. Coke, though they are making, they have a brand, they have a technology, they are able to make a very good product. They don't manufacture the Coke themselves. We work with Boeing. Boeing does the entire assembly done from outside. I mean, entire manufacturing done from outside. They assemble it. The only thing that they hold is their technology. They hold the patent of the products that they are making. They give out the manufacturing to somebody else. Sometimes it can be assembled also outside. Rolls-Royce also does that. Everything will be outside. They bring it, they assemble it, they write their brand name and they sell it. Now, like that, Coke, what it does is, there are distributors that are available who will manufacture the entire Coke and they will sell it. They will come to Coke only for the labeling, for getting the labeling done. When I compare what is the profit margin that particular company, which is my distributor, is making with what I am making, the difference, that is going to be my distributor method. What my distributor is able to make as a profit if he manufactures and he sells it without the brand name, and what I am making, the difference is going to be the distributor method. So that's the broad idea here. Cost approach is the last approach. Nobody uses cost approach for the simple reason that cost approach is not very reliable. That being said, in certain very few cases, like acquisition of third-party software, internally developed and internally used non-marketable software and assembled the workforce, you can go ahead and use your cost approach. How much would if I am using a software, Microsoft Office in my laptop, If I have to value that particular the asset, the value of that particular Microsoft Office license, why should I go on to break my head? I go to the market, I'm able to get it. What is the cost of replacing this particular software? I'm going to find out. The case of internally developed software, if I have a specific ERP which I built it for myself, what is the cost of reproducing it or replacing it? We'll have to figure out. Predominantly, reproduction is not much appreciated because reproduction of intangible assets is very tough. For us, what we want is for me to use is an Excel sheet. Doesn't need to be the exact line of code that is there. So reproduction is not needed, replacement is needed. My function needs to be solved. I want green color here, green color needs to be there. I don't want the same exact code that needs to run behind. Therefore, we don't usually use reproduction cost, we use replacement cost. Okay, I'm going to skip this. Some special considerations. I'll try to complete it in another 10 minutes. So that last 15 minutes, at least we'll have a question answer session. Now, discount rates. How do I go on to calculate the discount rates? In the case of intangible assets, calculation of discount rate involves significant professional judgment. How do I calculate it? It depends on individual valuers. There are certain factors that are given by the standard for us to consider, but it does not give this is how you'll have to calculate. It depends on the valuer. Now, when in selecting the discount rate for intangible assets, valuer should perform an assessment of the risks associated with the intangible asset and consider observable market or discount rate benchmarks. Whatever you can observe in the market, you should consider that. Certain things you'll have to consider in mind is intangible assets usually carry more risk than tangible assets. Therefore, discount rate should be higher for intangible assets. Next, if an intangible asset is highly specialized in current use, then automatically the discount rate should be higher. When there is a particular intangible asset which has multiple uses, I use it for X reason, Y reason, Z product, X product, Y product, Z product. I use it for multiple products, then the risk is low. But I use it for only one product. If there is some problem with that product, my intangible assets value will go down. Then the discount rate should be higher. Single intangible assets may have more risk than group of assets. Intangible asset in itself, when you are valuing, the value should be the discount rate should be higher because without the contributory assets, it cannot individually stand. Now, intangible assets used in risky functions may have higher risk. So, see how many of you know about CDMA technology and GSM technology? GSM technology was a hit. Mukesh Ambani was able to mint millions, billions maybe. CDMA technology was not a hit. Anil Ambani was not able to make any money. Though Anil Ambani was a forerunner. At that point in time itself, CDMA was also there, GSM also was there. Anil Ambani was backing CDMA. That did not fly off. Mukesh Ambani, he came in very late into the foray, but he was able to, he backed up GSM, which was the right technology. He was able to make millions or billions of dollars using that technology. So, intangible assets which are used in risky functions like this, it will be having a higher discount rate. The life of the asset is also important. The longer that you consider a particular asset will make revenue, higher discount rate should be given. Why? Because 10 years, I'm saying I thought CD drives will last for 10 years or 15 years. After, let us say 5 years after I thought that it would be standing for 15 years, 5 years it was replaced by pen drives. Nobody is using a CD or a CD drive or a DVD drive now. I remember having a CD drive, then there was DVD, then there was Blu-ray, this and that, and then it entirely disappeared. Now pen drives are there. Solid state devices have come into play. So that needs to be considered. Intangible assets with more readily estimatable cash flow streams will have a lower, if you have readily available information, then automatically the discount rate should be lower. I have a signed contract with the customer, sir. Automatically signed contract with the customer. It's an enforceable contract. Automatically discount rates will be lesser. If there's a customer relationship, I'll have to go and reach out to this guy. That guy has to acknowledge that relationship, and there should be a need for him to give me a contract all these ifs and buts are there, discount rates will be higher. So subject the cash flow, whether it is determinable immediately or not, will also form a reason, or it's a contributing factor for calculating the discount rate as a higher discount rate or a lower discount rate. Now, certain broad idea that they give, you'll have to calculate. You can consider the risk-free rate of similar maturities of the subject intangible assets. That needs to be considered. Cost of debt or borrowing rates with similar life of the subject intangible asset, that needs to be considered. Cost of equity, which is your equity risk premium of the participants of the subject intangible, which are using the subject intangible asset, same type of intangible asset, that needs to be considered. Weighted average cost of the company itself can be considered. In the case of transactions that has happened, what is the IRR for that transaction? You might have to consider. And then after all this, you might have to make sure that it is, you might have to find out that whether the weighted average return on asset, you do an analysis of calculation of weighted average return on asset and whether it is matching to make sure that your calculations are right, needs to be done. The other things are consideration. This one is an analysis that you'll have to do. Now, intangible assets, economic life is something that you might have to consider. That is one specific point. Certain intangible assets are for an finite point of time they will be in existence, which is limited by legal, technological, functional, or economic factors. There are very few intangible assets which have an indefinite life. Now, when you are considering legal, technological, functional, and economic factors, all four factors should be considered simultaneously, and the effect of all four should be taken into consideration. I'll give you an example. The example is given, not I, but the standard is giving you an example. There is a particular product which has a remaining patent life of 5 years. I hold the patent for the next 5 years. But I also have information that a better product is built by my competitor, which will hit the market in the next 3 years. Can I say that, sir, because I have the patent, I have 5 years of cash flow that is going to come in? No. The moment this new technology, new products going to hit the market, my product's value is going to decline. I might have to look at this, I have to look at that, I'll have to look at the technological considerations, and whichever is the lower value, I might have to take. So consider all four and decide the economic life of that particular asset. Certain times what happens is it will be cut down abruptly, and certain times it will go off smoothly. When you consider, when I said CD and pen drive, the moment I got hold of my pen drive, I stopped using CDs. But when it came to solid state device hard disk and the normal HDD hard disk, I don't know, for whatever reason, HDD is still there. Solid state devices came way back, about 7-8 years back, they came into the market. But even today, there are a lot of companies that are using HDD devices, the hard disk that you're using. So sometimes the change is abrupt. Sometimes the change is gradual. Slowly, hard disk is going to go away. The normal HDD hard disk is going to go away, and solid state devices is going to be there. SSD is going to be there. But it is gradual. It is not happening in one day. But when it came to pen drive and CD drive, pen drives changed the CD drives in a very short span. Very short span they changed. Nokia people threw away the moment Android came into existence. Nokia tried Windows and all. They tried all the tricks in their sleeves. Nothing worked out. Even today they are trying with Android. Nothing is happening. So sometimes it is abrupt. Sometimes it is going to take a longer time. You'll have to take that into consideration. Another thing that you'll have to take into consideration is attrition. What happens is you have your customers, and there is always going to be some customers who are going to leave you. Most of the time, we go on to do a constant rate of loss of customers. When you don't go very deep into it, when your intangible asset is not dependent on the age of your relationship with that customer, you go on to do a calculation where gradually every year 5% of the customers are going to be going to lose faith in your brand, and they're going to leave. This is number one. But sometimes what happens is variable rate is considered. The age of my relationship with the customer is taken into consideration. If I am with my customer, if the customer is with me for say 5 years, he's not going to leave. If he's with me for 2 years, there is a 50% chance he will leave. If he's with me for only 1 year, there is a 75% chance he's going to leave. If I'm able to make some analysis based on the number of years he has traveled with me, then variable rate of loss needs to be calculated. The initial stages, it will be very higher for a young company or young customer, and then slowly over the years, it will not change. Interesting example that I will give you, the Lay's chips that we had, it has a different consistency from the normal potato chips that were there before Lay's came into India. I remember having chips which were very thin, and it used to be salted and spiced up. It used to be very thin. And this particular chips is what people usually consume. When Lay's came into India, they were not able to immediately capture the market because the Lay's chips, they are not thin. They are a little thick and their consistency is a little different. The masala is also a little different. What they did is they went after the younger generation. They went after the school going generation. They gave a lot of freebies for the school going generation. Once they caught up with the school going generation, these guys who grew up with Lay's as a primary snack for them in the evenings, when they went to college, they had Lay's. When they went to employment, also they had Lay's. So today, everybody who goes to employment also has Lay's. But way back when they entered, they did not do that. So that kind of analysis, if you are able to do, variable rate of loss of customers can be taken into consideration. Attrition may be based on either revenue or the number of customers. You can do it based on the revenue loss or the number of customers also. You might have to segregate it separately based on the geography, based on the size of customers, based on the type of customers. You will have to separate it out. Why? Because in case of Netflix, this month I have paid my subscription fee. Next month I am not paying my subscription fee. Automatically, it means that they have lost a customer. But if, let us say, for a manufacturing unit, I am supplying some products. If that particular manufacturing unit is not has not placed an order with me for 1 month, does it mean that I've lost the customer? No, they don't have the need. They have made sufficient, they have already made sufficient orders from me. 1 year, if they have not placed orders with me also, I would not say I've lost the customer, because whenever there is a need, they'll come back. But if it is usually 1 year, within 1 year, they will place the order. After 1 year, almost 2 years, they have not placed an order, I can say that there is a loss of customer. So the circumstances would differ from case to case based on how I'm looking at it. Okay, I think this is pretty much that. I'm going to skip it here, directly go to tax amortization benefit. See, what happens is, in the market approach and cost approach, so one step behind, usually what happens is, intangible assets, if I am holding it in my name, I can claim the amortization of this intangible asset as a tax deductible. Depreciation, like how the depreciation on tangible assets, how I'm taking the benefit in the taxes, same way amortization of intangible assets also, I'll take the benefit. In the case of market approach and cost approach, this is inbuilt. It is automatically baked inside the system itself. But in the case of income approach, that is not the case. The value is not inbuilt. Therefore, what I will do is, I will calculate what would be the hypothetical amortization benefit that I will get from the particular intangible asset, and I will calculate the tax rate that I will have to apply. I will apply the tax rate, and what is the tax benefit that I arrive from this particular intangible assets amortization, I will calculate. I will discount it. There are two schools of thoughts. One school of thought says that take the discount rate of the company which is actually taking benefit of this tax amortization. You take the discount rate of the company. The another school of thought says that take the discount rate of the subject intangible asset, whether it is subject company or subject intangible asset, or this is the two schools of thought. But you'll have to discount it, whatever value that you arrive. This is called the tax amortization benefit value. You add it to the value of that intangible asset in the case where you are using income approach of valuation. Tax amortization benefit by way of amortization, what would be the value that I will arrive? Multiply it with the tax rate what is the tax benefit that I will arrive, discount it using either the company's discount rate or the subject intangible assets discount rate. Whatever value that you arrive would be the tax amortization benefit. This tax amortization benefit will be added to the value of the intangible asset, which is calculated by the basis of income approach of valuation. Only for income approach you can do this. So this brings us to the end of AS 210. Now I'll open the floor for discussion. Anybody who have any questions, we'll bring it out. Yes, Ketan sir, please go ahead, sir.
Good evening, sir.
Good evening.
Sir, generally we listen that if any company has a CEO, CFO who has resigned, then on that particular day or some nearby days, the value of the share of that company is fluctuate. So, do you think that we have to consider the such kind of the factors who is running the business for making the intangible valuation working?
Very good question. Whether a particular person being present in the company, can it be said that that carries a value? Yes, definitely it does carry a value. Valuing that intangible asset is very tough, but definitely it is an intangible asset that the company holds. I'll give you a better example. You have said resigning of CFO. No, if Ratan Tata sits in the startup that I just started a startup. Ratan Tata holds no shares in the company. I just invited him to join my company. He joined the company as a director, not an executive director, non-executive director. Naam ke wase, his name is there. Will that add value to my brand? 100%. It's going to add an enormous value to the startup. So that has a huge benefit. That intangible asset is going to be there. Valuing it will be a slightly difficult task. Yes, sir. Go ahead.
So, is any assignment has been carried out with such kind of this, not by you, but in the market?
I've not heard about that kind of this thing, but there is this usually goes as part of the goodwill. So it is not determinable. It is not directly determinable. They will calculate everything else as a startup for me, and they will arrive at a value. And because Ratan Tata is sitting there, they are going to add a 10% premium or 20% premium, and they're going to fund my valuation is going to go up. So that will be forming part of the goodwill.
Yeah, because recently some certain IPOs has declared that the certain cricketers are on my board, and so because of that the rate is much more fluctuate. Anyway, thanks for that.
Okay. Yes, Chetan sir, go ahead.
Sir, I'm a land and building valuer. So very often we see that when we are valuing properties, the category A builder, B builder, category C builder, of course their rates are little different. But where Cat B is there, very often sometimes Cat A is also there in the vicinity, and other Cat C are there. Now we try to explain saying that because of the brand name, there is a certain value that we are providing, which is again intangible.
Correct.
So, but then the difference of what by the premium and discounting that we give, and we arrive at a value that is what X value. This is what X plus 1 value.
Correct.
So the delta is what can be constituted as intangible.
Exactly. Exactly. The same brick, the same cement, the same sand. Probably if it is in the vicinity, it is almost similar plot of land you have. But if it just because it is constructed by say brigade, the value would be higher.
Of course.
So that is the intangible asset.
Okay. No, but very often we get into a debate saying that how can you give so much of a value to a brand? So let's say 5,500 becomes 5,800. So does 300 rupees is the value you're giving for a brand? That is where we get into a debate with the client.
No, that is there. That is there. See, what happens is what we should explain is how is this brand created and what is that brand. So in the case of landed building, it is very clear. If you go on to multiple sites, you will be able to see where this particular brand is there and what is the similar price nearby. Just because they are selling at a higher price, they are not sitting down without selling a flat. They are able to still sell the flat
Of course.
How are they able to sell? Based on the brand. It's very clearly determinable, and it can be. Only thing is we might have to do a little bit of justification in the report itself.
Of course. Okay, sir. Thank you.
A very liquidated example would be the iPhone. Somebody carrying an iPhone, they are not carrying it for the purpose of functionality, but rather for showing off that they have an iPhone. Somebody who comes in Audi, somebody who comes in a Benz, very rarely they look at the speed or very rarely they look at the comfort, but rather for showing off that they are capable of buying and riding a BMW or Benz is the key driving factor for buying that car. So that brand value needs to be factored always. Okay, better if we have the summary in the form of PDF with the iPhone example. I'll try to create an example. So this session was given to me on Friday, and I was traveling. I was in my in-laws' place, so I did not have. Though I know the subject, I did not have the time to prepare a PowerPoint presentation. Definitely, if I prepare a PowerPoint presentation, I'm going to share it with you. And I think in a couple of weeks, usually I'll take 2 weeks to prepare a presentation because it is a long drawn process of thinking it through. All the examples that I give you, I will liquidate it down into an Excel sheet and then I'll bring it out in the PowerPoint presentation. If it is prepared, I'm going to share it with you. Don't worry. Any other questions anybody has? Oh, my contact details. Okay, let me put it in the. I'm regularly speaking at TJF, so usually I can't type it. Okay, I'm going to share it with you folks, and once through Kajal, let me ask them to type it out and send it to you. Don't worry about it. I don't have access to my keyboard here. That's it. Anybody else who has any doubts, clarifications regarding intangible assets? No? Fine. So keep up the good share.
Sir,
Yeah, go ahead, sir.
sir, while you are making right now, you don't have the examples with you, but when you make a PPT for this, you please keep some examples which you have faced particularly in your life in the market, and as well as keep some examples, more examples for intangible assets for DCM, discounted cash flow method, and income method also, so that we will understand it, read it carefully and understand it, what you are just said. That would
Sure.
be okay with us.
Sure, sure. Definitely, I'll share that with you.
Yeah.
Okay. So anybody from DJF, please take over now. I think they're done with this session.
Yeah, thank you so much for this wonderful session. I know it's a very short time, short notice time for you, but it's an amazing session. And we just wait for the PPT. You just to prepare it, and we will share on the WhatsApp group with your contact details.
Sure.
So I
Thank
will
you.
share the details with everyone. Thank you all.
Thank you, madam. Thank you, sir.
Have a great evening.
Thank you, sir.
You all, Jai Shri Ram. See you all later. Bye.